If you've heard of a reverse mortgage, you probably think you know how it works. You get a check, you stay in your home, done. Here's what almost nobody tells you. That's only one of 4 ways a HECM can pay you, and picking the wrong one can leave real money on the table. I'm Janine Davis, a licensed mortgage loan officer here in Michigan and founder of Lifestyle Safety LLC. Home equity strategy is pillar 4 of my 6-pillar retirement framework, and today we're going deep on exactly one part of it: how a HECM actually pays you, and a purchase strategy almost no one in Metro Detroit has heard of. Quick refresher, a HECM or home equity conversion mortgage is an FHA-insured reverse mortgage for homeowners 62 and older. It's non-recourse, meaning you or your heirs will never owe more than the home is worth. You retain title. You're required to complete HUD counseling before you close. That's not a formality. It's there to make sure you understand exactly what you're signing up for. Now let's talk about the part most people skip: how you actually get paid. Option 1, the lump sum. This is a single draw at closing, usually on a fixed interest rate. It's the right fit if you have one specific need: paying off an existing mortgage, funding a major home repair, or covering a large one-time expense. The trade-off: once it's drawn, that's it. No remaining line of credit growing in the background. Option 2, tenure payments. Instead of one check, you receive a fixed monthly payment for as long as you live in the home. For life, guaranteed, regardless of how long you stay or what happens to home values. This is essentially a self-funded income stream from your own equity. For retirees who want predictable monthly cash flow without touching their investment accounts, tenure payments function a lot like a private pension. Option 3, term payments. Same idea as tenure, but for a fixed number of years you choose instead of for life. Here's where this gets strategic. If you're 62 to 66 and holding off on claiming Social Security, a term payment can bridge that income gap. Every year you delay claiming Social Security past your full retirement age adds roughly 8% to your benefit up until age 70. A term payment structured to cover exactly those years lets you delay claiming without touching your retirement accounts in a down market. That's a home equity decision and a Social Security decision working together. Option 4, and the one most people have never heard of, the line of credit. You draw only what you need when you need it, and the unused portion actually grows over time at a rate tied to the loan's interest rate. That growth happens regardless of what your home's market value does. For a lot of retirees, this becomes a safety net for healthcare costs or market downturns. Money that's quietly growing in the background whether you ever touch it or not. You can also combine structures: a modified tenure or modified term that pairs monthly payments with a smaller standby line of credit. Quick question before we move on: which of these 4 surprised you most? Drop the number in the comments, 1 through 4. Now here's the strategy almost nobody in Metro Detroit has heard of: HECM for purchase, or H4P. If you're planning to downsize anyway, H4P lets you use a reverse mortgage to buy your next home directly, putting down roughly 45 to 60% of the purchase price depending on your age, with the reverse mortgage covering the rest. You get the smaller, right-sized home, and you never make a monthly mortgage payment on it. Compare that to the traditional path: sell your current home, buy the new one in cash, and your other retirement assets never get touched either way. But H4P means you don't have to put 100% of the proceeds into the new house. You can preserve more of that equity in liquid savings or a line of credit instead of locking all of it into the new property. Before you move forward with any of this, here's what's actually required. You need to be 62 or older, and the home has to be your primary residence. You'll complete HUD-approved counseling, required, not optional. There's a financial assessment that looks at your income, credit history, and whether you'll need a set-aside for property taxes and insurance. Costs typically include an origination fee, a mortgage insurance premium of around 2% upfront and 0.5% annually, and standard closing costs. None of that is money out of pocket at closing. It's typically financed into the loan. And because it's non-recourse, you or your heirs will never owe more than the home's value, even if the loan balance grows past it. One quick note, since it comes up every time. Yes, a HECM does reduce what's left in your estate, but your heirs always have the option to sell the home and pay off the balance, keeping whatever equity remains. That's a conversation worth having with your family before you close, not after. Home equity is pillar 4 of my 6-pillar framework, and I review HECM structures as part of the free 6-pillar retirement review. As a licensed mortgage loan officer in Michigan, I can run the actual numbers on lump sum, tenure, term, line of credit, or HECM for purchase based on your specific home and goals. Book at lifestylesafety.com or call 313-450-9543. And before you go, which option are you leaning toward? Let me know in the comments. And a quick note. The Medicare annual enrollment period opens October 15th. I'm taking Medicare review appointments starting October 1st. Book early.